Big risk events this week for GBP and Aussie dollar with central bank rate decisions, and there's still many hot talking points around the dollar right now. Guys, Ken Chigbo here with a fundamental week ahead update for E8 markets. Let's jump straight into this. So on Tuesday, we do have the Reserve Bank of Australia's rate decision. Let's jump into some of these fundamentals that we've been observing ahead of this decision. Okay, firstly, looking at the labour market, right? With the employment change here, the last reading wasn't great, but we've had a decent run of jobs being added to the Australian economy, as you can see here. Look, these past previous readings. And this is inflationary. What do I mean by this being inflationary? I mean, if there's a decent amount of jobs being added to the economy, it means more people in the workforce and more people out to stimulate the economy, to help it grow. And then, of course, with that stimulation, of course, if people are out spending, they've got money to spend, and they're buying goods of this business, they're using this service of this business. Naturally, if you've got a lot of demand going on there, prices of these goods and services are going to remain high. And that, of course, is inflationary, right? So really important to note that there. And as you can see with the unemployment rate, it's generally remained pretty healthy. Okay, at the moment here, the last reading dropped to 3.8%, well, lower than the expected of 3.9%. So the labor market overall is performing relatively well. Okay, one thing to note. And then on the next thing as well that we saw the last month in April, CPI inflation. This is very important, guys. Inflation remains sticky. As you can see here on a quarter-on-quarter basis, jumped up to 1%, higher than expected and higher than the previous. On a year-on-year basis, which gives us a better picture of how inflation's performing, jumped up to 3.5% and the trimmed mean CPI at 1%. So what does that mean? If inflation remains sticky, right? We just saw with the labor market figures there, as I explained, remain inflationary because a decent amount of jobs being added, unemployment rate remains low, so that's inflationary. And now the key CPI figures, the consumer price index, prices are high. So how do we counter higher prices? How do we counter inflation? The central bank has to keep rates higher for longer. Remember, if we want to bring down inflation, we have to keep people's borrowing costs higher. We have to keep businesses' costs higher as well in order to try and cool down inflation, right? So this is one of the things to note heading into this RBA decision where, look, the labor market is tight. House prices have been rising. Inflation's rising. And they need to keep that in check. They need to try and bring that down effectively. They need to control those inflationary levels. So we're expecting this decision for them to maintain a bit of a hawkish neutral tone, for them to push back on any premature rate cut bets, okay? Because markets, it is immature actually if markets pricing in so early when the fundamentals state that they should not be rushing to cut rates. So I think there'll be a pushback on expectations there, which could potentially provide a bit of an edge and support for the Australian dollar. Now, when you look at the Aussie dollar, right, if we go on the higher time frame, first of all, on the monthly, okay, we staged a bit of a rebound there after obviously some selling, and this is obviously a dominant dollar at the moment, right? But we're pushing to the upside, and Aussie dollar is actually one of the better performers versus its peers. You see in the last 2 weeks here, and that sort of coincides with the labor market data, which we've been seeing, the higher inflation in Australia supporting Aussie. If you look at Aussie dollar versus the US dollar in comparison to other currencies versus the dollar, Aussie is actually one of the better performers. And I think that is an anticipation of this RBA pushing back on rate cut bets, any premature rate cut bets. So Aussie dollar's pushing to the upside at the moment. Now, if you look here, obviously on the weekly, you guys can see there's heavy supply at the moment around this sort of 66.20 area. You see in that latest week, rejection there at the moment. See there previously, early April. Yeah, the rejections, and then obviously in March, you can see those numerous rejections there. So this is heavy area of resistance. Now, really, right, if we just put this on the daily, you see those rejections. If we're able to break above this, it's going to give us room to run to the upside. So just keep an eye on this area of supply. If we do get an RBA pushing back on rate cut bets and this gets pushed further towards late 2024, this should provide some support for the Australian dollar. So you're looking out for the potential pushback there that may come from the RBA. Then on Thursday, we've got the Bank of England rate decision, so expect some GBP volatility. Now, before we go into the key fundamentals to note ahead of this decision, really important, right? I was saying this late last year that the main theme for 2024 was going to be the rate cutting cycle from central banks, the rate cutting race, right? Which central bank is going to be cutting first, and by how aggressive are they going to be cutting rates? Because Remember, when we're cutting rates, we're effectively potentially lowering the value of that respective currency. Okay, now see it from a foreign investor perspective. Interest rates are also the rate of return that a foreign investor can earn on their investment. So foreign investors are looking for where they can get the highest yield, i.e. the highest interest rates, the rate of return on their investment. Okay, so which central bank, which economy is offering the highest rate? So if a central bank is going to start cutting rates and faster than other major economies, the rest of its peers, then you're naturally going to see some weakness in that currency because people are going to be taking their money out and then go and put it in higher yielding economies. Other central banks that are offering higher rates of return than that central bank that's cutting rates. Hope that makes sense. So if we look at some of the key data points here for the UK heading into this decision, we've seen some stabilization in GDP. There were some fears of a potential recession where we had contraction here in GDP, but we've stabilized a little bit here. Now on the labor market front, look, this is the claimant count change. So we still got less people claiming unemployment benefits in the UK. We've seen a decent run of data actually there on the claimant count change. The average earnings, when you look at those remain elevated. So this is the wages people are getting paid. Remember, if people are still getting paid a decent wage, it means they got more money to spend and go out and spend. Remember, when we're spending, we're stimulating businesses, okay? We're keeping demand high. And if demand's high, they're only going to keep their prices high, if not put their prices higher, right? And that's inflationary. So average earnings is still high. The unemployment rate ticked slightly higher there. But then also very important, remember CPI, the central bank targets inflation down at 2% mark. Inflation's high here, look, 3.2%. The core, 4.2%. So with sticky inflation, what should we be expecting for the Bank of England on Thursday? Markets are trying to price in rate cuts at the moment in August. But I still think if we pay attention to these key fundamentals, right, i.e., the labor market remains relatively tight. Inflation's still sticky. GDP is generally stable. The economy's still okay. It can withstand higher rates for longer. Maybe the Bank of England has room or reason to want to push back a little bit as well. Maybe they're still too premature to price in imminent rate cuts, which if they do push back as well, and they don't expect that to happen until maybe towards the latter stages of this year, then obviously that's going to provide some support for the pound. So if you take a look at GBP versus the dollar here at the moment, we haven't got a full-on committed trend right now, have we? And it goes back to what I said earlier about the rate cutting cycle. That's going to be the next thing that really creates a breakout of those ranges. Who's cutting first and by how aggressive? And remember, right now, the FOMC in the United States are keeping rates higher for longer, and so the Bank of England. On a monthly here, obviously, we've been gradually grinding ever so marginally to the downside. Obviously, as I say, not full-on committed trends. Last week, we managed to finish in the green, and obviously the week before last as well. We do have this sort of trend line that's sort of keeping the price supported at the moment. I wouldn't say largely to the upside, but we do remain supported. Price action here, you could potentially view this as a descending channel or what could be a bull flag, which we're trying to break out of at the moment. Either way, you guys can see supply resistance at the moment around this sort of 25-50 area, which if we do manage to break above that, if you look left here, there is room for this to push to the upside. Now, the fundamentals, the technicals could go hand in hand with the fundamentals so long as the Bank of England does push back. Now, obviously, we went over those fundamentals there in terms of why the Bank of England could potentially push back on premature rate cut pricing. And obviously, this could, in theory, take GU for another leg to the upside. As we've seen in the past, as I say, if we break this 25-50 area, we could have room to run in towards 127s and perhaps even above there into 128 territory. Now let's round off with the US dollar, which has been very volatile and obviously sensitive to markets trying to price in rate cuts from the FOMC. Now, if you look here at the Dixie, right, the last 1, 2, 3, 4 consecutive months so far, we've been trending to the upside. Now, the reason for this shift to the upside at the commence of this year, I was calling this, okay, because we had all this downside late last year and markets were aggressively pricing in rate cuts to come for 2024. But the economy, the United States economy was still very much hot. You know, labor market was tight, inflation sticky. We had various economic indicators were just showing that the US economy is outperforming the rest of its peers. So then the markets had a realization and started pushing back on those rate cut bets because of everything I've just said. So that's why the dollar is sort of trending to the upside here. They realized, look, the FOMC aren't going to be cutting rates anytime soon. So dollar has allowed this run to the upside. As you can see, we remain structurally to the north. We've been printing of late since the commence of this year. We've been printing higher highs and higher lows. As you can see, structurally to the upside, got this trend line of support there after a breakout of this descending channel, what you could view as a bullish flag. And obviously last week and the latest week, we caught a bit of downside. Just a couple of reasons. One, we had an FOMC which wasn't as hawkish as it could have been because they played down, Jerome Powell played down the idea of a potential rate hike because, remember, inflation's been sticky, so markets thought maybe they could hike rates in order to try and kick inflation to the downside, but he ruled that out. And in terms of their quantitative tightening, in terms of withdrawing some of that stimulus from the market, they're not going to be doing that as fast. The withdrawal of that, they're not going to be doing it as fast as some of the dollar bulls would have liked to have seen. So that's why we headed to the downside, allied with the slightly softer labor market readings of late. Unemployment rate ticked higher to 3.9, less jobs being added to the economy and NFP. And then wages went down. So all of that was a little bit disinflationary. So keep an eye on, obviously, this trend line, which is being tested. Remember, with a Dixie, it's heavily weighted euro, over 50% weighting euro. So we'll keep an eye whether we could get a bounce this week and resume to the upside and go and print, perhaps stage a rebound for a new higher high as part of this structure. Or obviously there is the risk that we break out of this trend line of support and start edging to the downside and start paring back this move. Personally, I do remain a dollar bull until I see things drastically shifting, i.e. on the inflationary front. But we will see. As I say, very much hawking all these economic data points right now for the dollar. So guys, that's it for all the major fundamental talking points for this latest week. Other than that, stay lit, stay blessed, and I'll catch you on the next video.